Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on Newstalk 780 KOH. It's a pleasure to be with you and a pleasure to be with my co-host. Guys, I almost said happy Friday, but you're number one, you're here and it's not Friday, it's Thursday,
Right.
but it is a Friday for me because the markets are closed tomorrow. So I'm all mentally screwed up more than normal.
You're also eager for the week to end. I know you are.
I am so eager for this week to end. I love what I do for a living, Aaron Clark. But yeah, I am ready for a 3-day break. I tell you, I really am. This has been a long haul for this last 5 weeks as far as the market is concerned. So yes, looking forward to some great time with family. Hopefully. All right. Well, that was Aaron Clark of Liquidity. How you doing today, Big A? First of all,
Doing great. Yeah. Doing
good.
great. Looking
Glad to
forward to
hear
the
it.
show tonight.
Absolutely. It's going to be a great one. You betcha. Dwight Millard on Q Home Loans. How are you, my friend?
I'm doing fantastic, John.
Good.
Ready for the weekend. One more day to dodge. One more day to play dodgeball. Right?
That's a good way to look at it. Yeah, that's a really good way to look
I
at
asked
it.
you. I asked you before the show started. I mean, they've got the big, employment numbers coming out tomorrow, and everybody's closed. So I don't get it.
Yeah, I remember years past. It's funny you bring that up. I was thinking this morning. I remember years ago. I mean, this was like. I remember I just bought the ranch. It was like 2010, 2011. And we're, off on Good Friday, of course. And OPEC had a major meeting. And I can't remember what I had for dinner last night, but I can remember sitting at the kitchen table for breakfast and the OPEC news came out and oil went crazy then. So how funny is it now? We're still worried about oil, but that was a different scenario. But you're right, Dwight. We do get the ever so important non-farm payroll numbers tomorrow. Markets will be closed, but obviously we'll deal with it on Monday, right? It'll still be here. We'll deal with it. On Monday.
John, and I know you probably will cover it, but I mean, according to Trump, we've got more oil than we got lots of oil, and you would have thought oil prices would have just.
His words were they should be buying from us. Forget about the Strait of Hormuz, buy from us. Which we've all said that we're a net exporter, we're not a net importer, and so you kind of question this whole scenario there. But no, you're right, Dwight, and what a day it was. First, folks, let me tell you what we have lined up for you after I go through today's wild ride on Wall Street. So much of it attributed to the president's speech last night. It's when all the fun started. But real estate has long been called one of the best ways to build wealth. We all know that. We all believe in it. We all do it, so on and so forth. But here's the question I want you to be thinking about. Is it really the best way, or I should say the best strategy for retirement income? You see, I get clients all the time that, and sometimes we will recommend. We're one of the few financial advisory firms that actually recommend to our clients many times to put real estate in the portfolio. Most advisors won't do that because that takes the assets away from them. Well, we don't care about that. We're in it to do the right thing for the client. So we deal with the situation a lot, hence why I brought up this topic, which is it really the best way to, I won't say exclusively provide your retirement income, but a portion of it? And the answer is yes, it really is. But like anything else, before you jump into it, you've got to understand how you're doing it, because it's different, right, Aaron Clark? It's different when you're looking at investment real estate to be a supplemental source of income to you, whether it's retirement income or some other source. It's different than the guy or gal that says, I want to buy this property in the hopes that it's going to appreciate, right? It's a completely different animal. And so what we're going to do today is we're going to kind of go over really the facts about how you do this, how you purchase the rental to supplement the retirement income. We're going to talk about the importance of the cash flow. Aaron's going to talk about how he and Corey, crunch the numbers to create cash flow, and really, and we're not just talking cash flow, folks. We're really talking getting down to the brass tacks, getting down to the actual net number, because it's easy. And we all know we have friends, or maybe you do this yourselves. Oh yeah, I'm making whatever, $2,500 a month on my rental property, right? Aaron's just laughing. Make $2,500 a month on my rental property, and then you get someone that knows what they're doing. You're saying, no, really, what is your true cash flow? What are you netting? Oh, I'm up, $400 a month by the time everything is paid. Like, okay, it wasn't as good as you thought it was. So we'll go through that. We'll talk about the taxes. We'll talk about really some of the mistakes that we see a lot of people make when it comes to utilizing real estate for retirement income. So, if you're counting on real estate to fund your retirement, again, we're big advocates as anything of being a diversified portfolio, that it's one of your sources of retirement income, because it can do a lot of things that the stock market can't, right? But bottom line is, you have to understand the rules, because Aaron, I think one of the most important things that you and Corey always try to emphasize, and I want to just make this point before I move on to the stock market side, which is you need to understand your reason or your intention for buying real estate, right? So many people will just go out and say, I want to have a rental. I want to become a landlord. I've seen people get rich with real estate, but they don't have that goal. They don't have that specific intention. And what ends up happening is they waver, right? It's like a drunk driver going down the road. They're going to the left side or the right side. They don't really know what they're doing. Instead of saying, all right, I need to go from point A to point B. That's my reason for owning the real estate.
Exactly. I mean, I'll give you two quick little example
Please.
snippets. Sometimes I have people that are looking at it strictly for cash flow and they want that immediate return right away. But then I have people that are very strategic where they know they've got a couple kids that are going to grow up. They're going to go to college out here. They know what it costs to pay for a dorm. And so they go, you know what? It's better if I buy a house now. I may not be making a big chunk of money monthly on it, but my goal in that is to save money as opposed to make money. So you got to take into consideration what those goals are and then customize whatever opportunity there is around it.
Yep. Yeah, absolutely. Dwayne, real quickly, how often do you get into, as the lender, do you get into really finding out what the goals are of that person? Like to Aaron's example and my example. Does that really matter to you much as a lender?
I mean, it does, but I think the more thorough you are, when they call you, hey, I'm looking for my primary or investment. You can tell when somebody's got 4 or 5, 6, 7 properties.
Okay.
You can dig pretty deep into that and kind of strategize. I mean, I've got one right now that listens to the show, a client that is looking at maybe leveraging a couple rental properties to buy another primary. So, I mean, yeah, it's one of the things, though, I think the biggest, probably the problem, the pitfall in this is listening to somebody else rental story, right, Aaron?
Good
I mean,
point.
it's from your dentist to your mechanic. It doesn't matter. Everybody's got a gleaming story because they can't have a failure
Just like their
story.
stock market returns.
Yeah. So that's probably the biggest pitfall, I think, to your point is, I'm making $3,000 a month, my payments, and, it's just not that way in every case. So
Right. Absolutely. All right. Well, as Aaron said at the beginning of the show, this is going to be a great topic, and it is. So we're really looking forward to sharing this with you. But first, let's get down to the stock market side of things. And we need to go back, 23 hours ago, because the president's speech was at 6 p.m. our time last night. So no one really knew what was going to happen in this speech, right? As I shared on the show yesterday, it kind of bled out through some of the sources. He was going to talk about winding down the war, 2 to 3 weeks, right? We've been hearing that all this week. So we thought that was going to be the situation. We knew he was going to bash NATO members for not helping, come in and help out on the Strait of Hormuz, those type of things. But what we did not expect were some of the comments that he made earlier in the day, which is basically blow Iran to oblivion and send them back to the Stone Age. Well, he said it on national TV, right? Now, let me say worldwide TV, because we know the rest of the world watches the speech. And soon as he got done saying that, guys, I was watching the futures very closely. They began to dip, and oil prices began to go up and go up and go up. And when I got up at 3 o'clock this morning, and I, as always, I'm a sick individual. I check the futures and I look and see what oil's doing, and I just about fell out of my chair. I mean, they were down. The Dow futures were down, I don't know, 230, 250, somewhere like that when I went to bed at about 9 o'clock, I guess it was last night. And then when I saw it this morning, down 400, down 500, down 600, and right before they opened, down 700 on the Dow futures. Oil was not up $1 or a couple dollars. Oil was up, $8 and $9 and $10. And before we knew it, I think when I did my first update at 5:23 this morning, we were up. Matter of fact, I'm going to go back to my notes here. No, pardon me. It was right before the open. We were up $13 right at the open, actually. We're up $13.06 a barrel to $113.18. Think about that, guys. Think about that for just a second. And when I started my first report, we were at $110.21 a barrel, up $10.11. So from 5:23 this morning to 6:30, we went from $10.11 a barrel to $13.06. I mean, in an hour. That's how fast oil prices were rising based upon the president's speech last night, and then how fast the stock market was falling. So we open up, and as usual, it's usually, the pre-market many times will not be as worse as what the opening is going to be. And that was kind of the case. We went from that 700 point loss. We were down, I don't know, 600 and some change, still obviously very severe. And then things began to stabilize. And I'm not kidding you guys, within 2 hours of the open, so right around 7:30, 8 o'clock, right around there, The Dow went positive. And oil prices didn't come down that much. And that's kind of the way the whole day ended up finishing out. We just had very small losses across the board, even though oil finished up $11.34 to $111 a barrel. Go figure that. It's an absolute head scratcher. I mean, you look at that and you go, I mean, we were freaking out when we'd have a day when the oil would go up, $1 or a couple dollars, and to go up $11 plus, and then we get out of the day with a like I said, a very, very small loss, 61 point loss on the Dow, up 38 on the NASDAQ, and up 7 on the S&P 500. So 2 out of the 3 major averages made money today. It's crazy.
It's your Good Friday gift. It's your Good Friday
exactly.
gift. It's got to be.
Yeah.
I mean, because you're right, John. I was watching. That sickness is coming over to me. It has been.
I'm sorry, man.
I'm looking at it first thing going, oh no, here goes bond yield, the whole thing. But bonds survived the damage today too. So
yep, absolutely. Yeah. All right, we'll come back, talk a little bit more about the market, then get ready for our topic: real estate and retirement, smart strategies, or can they be costly mistakes? With Aaron and Dwight. Let's turn it over to Kristen Snow right now. Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Dwight Millard of OnQ Home Loans and, of course, Aaron Clark of Edge Realty. Aaron, I just want to say we've enjoyed having you on the show so much these last month or so.
Thanks.
You're so much fun to have on. All right, once again, we finished down 61 on the Dow to a close of 46,504. NASDAQ up 38, closing at 21,879. And the S&P 500 for the day, just a small gain of 6,580, or close at 6,582, a small gain of 7. Now, I forgot to mention another catalyst today that took us from that 700-point loss earlier to, again, just a 61-point decline. And again, call me crazy. Tell me if I'm off my rocker, guys. Driving force was Iranian news agency came out, and this again was when things turned around. Iranian news agency came out and said that Iran and Oman are looking to sign a joint agreement to basically control the Strait of Hormuz. Now, tell me what's so good about that.
Yeah,
but the market went up on it. When I started to see the news break on it, I'm like, wait a minute here. This, and the details were very sketchy, but yeah, now you got 2 countries involved with controlling, 20% of the global oil trade going through there. So I've thrown up my hands trying to make sense of it because, and what I love though, is there's a lot of people a heck of a lot smarter than me, big, massive money managers, and they're all saying the same thing. The whole thing makes absolutely no sense the way that it's performing, right? And again, today was a prime example. If you just joined us, $11.34 gain on oil, $111.48. We're up, like I said, up over $13 early this morning before that Iran story broke. Gold for the day down $133.20, $4,679.20 an ounce. And pretty quiet, Dwight, on your world, down 1 basis point on the 10-year, down 13 basis points. Yeah, you heard me right, down 13 basis points on this holiday shortened week. Let's talk to the mortgage side, my friend.
Yeah, so, I mean, keep it easy. We're down about 25 basis points from the run up to 6.6, 6.7. We're at 6. Yeah, we're at 6.41 today, according to Mortgage News Daily. Again, your governments, FHA and VA, 5.88 and 5.9. I mean, it's slow. As we always talk, it's slower to come down than go up.
Yeah,
right. And so it's a little bit at a time. So, but it was John, I think it's been a great week for bonds, as you were talking about, 13. And we got a little relief, but I don't think it's anywhere near what people were hoping and wanting that when we were, 4.5 weeks out.
Do you guys feel like I do that we're just one Trump comment, one news headline, one missile hitting the wrong oil facility, just one something away from this whole thing unraveling and it getting severely worse than it already is? Do you feel like
Yeah, I mean, John, I do. I think we're living on that type of news flash. But anything hitting like a mine or something, can you imagine that?
Yeah. Aaron, you feel the same way?
Well, I just laugh because it reminds me of the times in the old days before Trump when you could check things out like once a week or once a month and there was very little change. And now you could wake up in the morning and check anything and anything is just changed completely.
Aaron, heck with waking up in the morning, brother. I'm talking
or multiple times
hour.
In a day.
Yeah.
So, I mean, I guess for people that are in a position where they just constantly need action, it's great. But for people
Absolutely.
sitting back going, I just like
you're
the easy
yeah,
ride.
yeah. No, if you're a trader right now and you can figure this thing out, yeah, you've probably made a lot of money. Or
Yeah.
the downside, as I've read many stories, there's a lot of hedge funds that are now out of business because, again, I don't care how smart you are or how sophisticated algorithms you have. This has been an extremely difficult market because, exactly as you said, Aaron, it's headline driven, and no one knows what that next headline is going to be.
Yeah.
No one.
But
knows
John, in the first term of Trump, you said that way back then.
Yep. Yep.
It's good for radio,
Yeah.
So bad for your portfolio.
And I warned the same thing.
Here we are again.
When he got elected, I said, it will not be boring. There'll be plenty to talk about on the radio show for the next 4 years. You're absolutely right. Aaron, let's get our first point going. Once again, we're talking about real estate and retirement, from a cash flow perspective. Is it the right thing to add to your retirement portfolio or retirement income? So Aaron, let's get this out of the way before we go to breaks. Let's you and I talk for just a second about why retirees love real estate. But at the same time, it can also be dangerous.
Absolutely. I think that the big thing for people that love it is that it feels safe because they can see it. It's tangible. They can drive by it. They can kind of control it, from a perspective of like, if they don't want the tenants that are in there, if they don't want the prices they're getting, they can adjust whatever they want to adjust. And there's some power and comfortability in that.
That's a good point. Yeah. What about the old saying, mailbox money? Right? That rent check should be coming in every month.
Comes in every month. When you have your investments that are tied up in your world, right? People they got to log into an account to kind of see it or ask you or whatever. They don't have that tangible check. And so I think for some people, it feels safe from that perspective. But the question is that safety real? And just because you see that money coming in doesn't mean that's the best option. And that's a lot of what we're talking about in the topic. Because I get a lot of people that instinctually run to real estate, and I sit there and crunch the numbers with them, and I go, "You're going to make $50,
exactly,
but it's going to cost you $200,000 to make $50.
That's right.
You could stick that in a savings account and make more money, with
zero
risk."
Yep. You're right. And you've alluded to many times that's becoming, or it is very common now because of the elevated prices of houses, elevated mortgage rates, right?
Absolutely. Yeah. I mean, right now, you got to be in a good position for it to be a good investment.
Well, and again, unless you're very sharp, or hopefully your team is very sharp, which they should be, what a lot of people also forget about is the cost of money, right, Dwight? I mean, that loan's not coming for free. You have that interest cost, you have the expenses, you have all these different things, but also you have the opportunity cost of money. I mean, if you put, let's just pick a figure, you put $100,000 down on a house as far as the down payment. That, to your point, Aaron, that money could be working for you in a lot of different areas, and people don't calculate that as they should, right? You should have. I remember, Corey years ago showed us this beautiful spreadsheet you guys use that really, really breaks down when you're analyzing a deal for a client. It really breaks down everything to get to that true bottom line net. Here's what you're going to make, assuming this is your rent number.
Absolutely,
John. I had a commercial landlord, real quick, that he wanted to pick up his check, so I had corporate mail it to every month. He'd come in, but he would just do his rounds, make sure the property looked good, and I'm sure he did it, with all his other little properties. I called him Magoo, but he came like on the second every month. But he was the nicest guy, and he'd just do his little, make sure everything was good. So
was he an older guy?
Yeah. But he loved it.
Old school.
He loved it.
Yeah. Yep. Hey, that to me is a great thing to do, to go pick up a check. Nothing wrong with that. All right. When we come back, Aaron's going to dive into our second point of utilizing real estate as part of the rental income, or the retirement income scenario. And that is, he's going to take us behind the scenes with the real math, what you really need to look at to see if this deal makes sense for you, right? It's not just, I'm collecting $2,300 gross month, per month. No. Wait till you hear what he has to say about that. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hello, Jack. Back to the Jon Sanchez Show on News Talk 780 KOH with Aaron Clark of Edge Realty and Dwight Millard of OnQ Home Loans. Once again, we only lost 61 on the Dow after being down 700 in the pre-market session. NASDAQ rose 38. The S&P higher by 7. Once again, the big talk of the day, the oil prices. Marketable market on the stock market side, when you see these oil prices up $11.34, $111.48 close. Just absolutely incredible. And once again, another reminder, Market is closed tomorrow. You'll be getting a best of me tomorrow. All right. We just started our discussion, real estate and retirement strategies, right? Looking at real estate as a supplemental source of retirement income, as a diversifying source of your retirement portfolio. All right, Aaron, it is a financial show. So that means we've got to talk the numbers, brother. We got to talk the numbers. Let's talk about getting in without getting too deep into the weeds, but let's really start moving into the math behind the rental to see if this rental income, to see if this really makes sense. Talk to us about some of the things you're looking at there to come up with that number to say good or a bad deal.
Yeah. So, typically when people are looking at rental properties, they're looking at, okay, what's it going to cost me? What's the payment going to be? And then how much money am I going to get from the tenant? And they don't think about any of the additional things that you have to include in that. So when Corey and I sit down with somebody, we end up talking more people out of these transactions than doing that because the numbers just don't make sense. And we're going to be honest with people about it. So, you have to take into consideration what your maintenance fees are going to be if you're going to hire a property management company to do all of the upkeep on tenants and background checks and applications and that kind of stuff. You have to do a consideration for vacancy because you don't want to be in a position where, let's say, if you have vacancy for a month or 2 months or 3 months. I've had clients where they had really bad tenants and then they ended up kicking them out because of not paying. So now they've got a vacancy of a month or two from them not paying because for 2 months they were trying to get them to pay instead of just getting rid of them. And then when they got them out, then the amount of maintenance costs to get that place repairs. Back up after they just put new floors, new this, new that, and now they're redoing all of it again. You could be in like the $10,000 range easily in a situation like that. Easy. Yes, so you have to take into consideration your vacancy as well as the obvious ones, taxes, insurance. If a property is in an HOA, we have a lot of places that are condos and townhomes and things like that. They have HOAs. We have to consider those costs. And lawn maintenance. A lot of people don't want the tenants doing lawn maintenance because they don't do it. So they'll hire somebody to do that. So when you start adding all of these numbers together and you start computing those into or calculating those towards what the actual amount of gross rental income you're getting, you start looking at the numbers. And like I said, in my example, you're looking at $20.
Yeah, right.
Okay, I spent $300,000 to get this $20. Yeah, and a lot of people, their pushback on that is, okay, yeah, but 20 years from now, it's going to be worth $10 million. Right. And they've got that whole dream. You never buy investment property from a standpoint of appreciation. Ever.
Thank you. That was what I was going to ask you. I think that's a excellent point. Yeah, because you see that over and over again. I'm buying it for the cash flow. I'm buying it for the future appreciation of it. That's what I did on my personal residence, right? And it turned out great and everything else. So I'm going to use that same philosophy with the rental, and it's going to supplement my retirement, and everything is just going to be great. But quickly, why do you advise that? Why do you say don't look at the appreciation when you're buying rental properties?
Well, because you don't know which way it's going to go. You don't know if the market's going to crash, if it's going to go up, if it's going to go in any way, shape, or form. And then on top of it, when you go to sell that property, even though you might have all the depreciation, we talked about this on Tuesday, you're going to have the depreciation you've written off every year when you did your taxes. You're going to owe back. Tax. Yep, and you're going to have your capital gains. It's a business, so you don't just cash. You don't just pull the lever and then the money comes back to you. There's a whole lot of expenses that go in that. So you can actually go in a negative direction on that. You want to count the cash flow.
And as basic as this sounds, I still get this question a lot, so I'm going to bring it up. People still think that $500,000 tax-free exclusion you get on your primary home if you're married, that applies to rentals. It does not, as Aaron just said. Yep. Every dollar that you have as far as the capital gains, and I'm talking a net capital gain, obviously you have your purchase price, and then you can reduce that purchase price, increase that purchase price on paper by all the repairs you've made, et cetera. But when it's all said and done, that capital gains tax, again, depending upon what bracket you're in, and, it can go from 0% all the way up to 23.2 or 23.3, percent. That's on top of, right, Dwight, being in a state like a California where they have their own state capital gains tax. I was just talking the federal side. So easily you can see 25, 26, 27% if you in a high enough bracket. Then you come back to, like Aaron said on Tuesday's show, if you missed it, please pick up the podcast or the YouTube on it, because this is the tax. And I swear, guys, I see this all the time. I'm sure you probably do too. fail to, not all, but some accountants fail to tell their clients about it when, because we always send a client to their accountant if they're come to us and say, hey, we're thinking about selling this rental and investing the money with you. First thing, go to your accountant, run the tax numbers, but the 25% depreciation recapture. So again, if you depreciated $100,000 of this property, you're going to owe roughly $25,000 tax on that. That's a big surprise.
Mm-hmm.
It's that's why I call it the gotcha tax, right? So there's a lot of different things there. But Aaron, the other point too is, I think people a lot of times, to your point, they're looking at gross rent numbers. They're not looking at the net income rent numbers.
I mean, cash flow isn't what you collect, it's what you keep, right? So those gross numbers don't really mean much when you start putting them against the expenses that it takes to own that property.
Dwight, let's bring you into the.
I want to add in the scenario, in the cash flow analysis that we have. There's a reason why mortgage companies use 25% rent vacancy factor. I mean, it's probably a little high, a little more conservative, but to Aaron's point, that covers those 3 months, the 4 months, the fixing. So maybe it is on the high side, the 25%. We're never getting away from it. As long as I've been in this business, to Aaron's point, I mean, you can calculate 7.5, 8, 9, 10. I think you might be a little bit, light there, on that. Right, Aaron? Okay. I don't know, but 25 is a little steep, but I think single digits is too light.
Yeah, I mean, we've been in a market where it's single digits, but that could turn at any minute. You never know.
Yeah, absolutely.
You got to be safe.
Now, guys, let's get into the liquidity issue, right? This is another, I won't say it's a downside, but it's just something everyone needs to be aware of, right? When they come to us, they've got a stock market portfolio. I don't care if it's an IRA or taxable account. It's liquid, right? It can be sold. Sometimes there's taxes due, sometimes there are penalties and taxes. Sometimes there isn't. But Aaron, real estate is not a, quote, liquid investment, right? If a retiree is using that real estate to fund their retirement or a portion of their retirement, what happens if you need cash fast? What happens if the market slows down? What happens, again, big vacancies? What happens if the property doesn't sell? No one ever thinks about that.
Yeah, I mean, in a hot market, sure, you could turn that thing and probably get cash in your pocket in 30 days. But that's not a typical market. Our typical market, you're going to need that cash fast, so you could go, Dwight can speak on this, but you could get an equity line or something like that to pull some of that cash out. But a lot of people don't even understand how those work. And the fact is, on those, if you don't understand them, you end up paying an interest-only payment on them. They never get paid off. They keep increasing in balance, and they end up hurting you in the future. So you have to talk to somebody like Dwight who can explain it. And even then, you're still waiting for the time to process, and now you're taking away from that net proceeds because you've just added another expense to that, as opposed to just selling it and being done and collecting that cash and making it liquid.
Yeah. I was going to say that just clobbers your cash flow analysis, right? And it takes everything that you tried to start off to do. It kind of now is counterproductive, counterintuitive. If you've got to go borrow from it because you weren't planning on, fixing it up or hot water heater. I mean, it's like a car sometimes, John, just about when you think you're in a good spot, your transmission goes out, right?
Yeah, right.
Same with houses.
Two more payments left. There goes the transmission. Yeah. I got to trade it in and start it all over again. All right. When we come back, we're going to wrap things up on our real estate in the retirement income portfolio calculation with Aaron and Dwight. Let's wrap it up with Kristen Snow. She's in the Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH with Aaron and Dwight. Aaron, your phone number, please.
673-6700.
Thank you, sir. Mr. Millard.
Yes, 240-2022.
Beautiful. All right. We've been talking about, again, real estate utilized in a retirement portfolio specifically to produce retirement income. Whole different animal. We talked about the tax side of things. We could make an entire show on that. But Aaron, let's wrap things up with this. What do you think for the average person out there right now is advice? Meaning, is one portfolio 1 to 5 enough? 10 of them. Where's kind of the sweet spot, or is there even such a thing?
You mean like for diversification?
Yeah, exactly.
So, I mean, I think it's good for at least everyone to have a little bit of real estate holdings.
I agree.
I think that it would be good for somebody to try to get their feet wet and get in on one as soon as possible.
See if they like it.
Yeah, feel it out. Because it's definitely, like you said, it's a different animal. It's something, I have people that have done it. They bought 5, 10, 15, whatever. They thought they were going to love it. And then a few years later, they're like, get me out of this. I hate it. I don't want to do it. This is the worst thing I've ever done in my life. And then I have people that are the opposite. They get in on one and they I mean, they literally become addicted. They form their own corporation. They get multiple of their buddies involved, and they start being moguls. Yes. So I always say, it's good to start on one. One is good too, because like I have a lot of people, they go, what should my first one be? And I go, well, are you going to live in that same house when you retire? And they're like, no, I want to get a smaller little condo, blah, blah, blah. That should be your first one then. Mm-hmm. Get a small little condo, because then you can transfer into that when you get older, and it's paid off now. And now rent out your primary.
And that's a whole nother topic. Talking about taxes, Aaron, that's a very formidable strategy that we look at and advise on a lot of times. You're doing exactly that. You're buying that. And Dwight, right? You've done this a lot, like on the vacation side, right? So let's say you live out of there and you're like, Lake Tahoe is my dream. It's where I want to move to. So you buy that home, you rent it out, so on and so forth. And then 20 years go by, 10 years, whatever it is. And you're like, okay, I'm going to move into it. Well, guess what? All that depreciation recapture, all that capital gains we were talking about, you're going to move into it. And then the goal is you want to stay there at least 2 out of the next 5 years, because then you can sell it. And again, if you're married, make that $500,000 profit. I've had clients that have done that year after year, or not year after year, but every 5 or 10 years, they will start to do that. Yeah. And man, oh man, they just absolutely love it. And it's a great way to, kind of dodge the tax bullet and let someone else kind of pay off that home. So maybe it is paid for by the time you hit retirement.
And it goes faster than you think, John. It goes fast. People, to your exact thing. Aaron's had clients. I've had clients. That's what they've done, and they're in that. They're in that space now. So
yes, absolutely. So we're going to kind of wrap this up with saying this, like we started the show with: real estate is a great asset diversifier versus the stock market. You can get the check in the mail, even though we can kind of do the same thing on the stock market side. But once again, it's all about diversification. Right? I don't care if it's the real estate, the stock market, a small business, whatever it is. Have a little bit of everything, right? And that way, your eggs are not all in one basket. You can weather the various economic storms, rising interest rates, falling interest rates, you name it. Good diversified portfolio. Most important, have the team behind it. You should have a great retirement. That's the goal. That's why we do this each and every day, to make sure all of you do that. Mr. Clark, Mr. Millard, I wish both of you a great Easter, and to all of you, I hope you have a safe, wonderful Easter. I'll be back with you on Monday. Happy Easter, boys. Hope the bunny's good to you.
As well.
All right. God bless. See you, everybody. Take care.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited, an equal housing lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.